U.S. Natgas futures rose more than 6% to above $3.60 on Wednesday, driven by disruptions in supply and strong global demand. Today's EIA storage report printed a draw of minus 40 billion cubic feet, in line with market expectations, while much smaller than the 5-year average, increasing surpluses to 207 BCF larger than the 5-year average. Meanwhile, natural gas exports have been steadily declining since late December, falling from 16 billion cubic feet per day to nearly 12 billion. This suggests that the current price levels are largely speculative, driven primarily by concerns over colder weather forecasts rather than underlying demand fundamentals. This means that a price correction could be severe if weather forecasts shift toward warmer conditions as we approach the spring season. Nevertheless, demand remains strong as bitter cold sweeps across the interior U.S., driving temperatures below zero in northern states and keeping overnight conditions chilly in the south. Daytime highs struggle to reach freezing across much of the Midwest and Northeast, reinforcing the need for heating. This pattern is forecasted to hold through January 19 before a brief moderation. With a shift to milder conditions, demand strength could taper off before late January. The West Coast, by contrast, continues to experience milder weather. Conflicting weather forecasts persist, keeping the market on edge. Earlier this week, the American model added 2 heating degree days, signaling a potential boost in demand, while the European model reduced its outlook by 8 HDDs, pointing to milder conditions. Both models agree on colder weather over the next 2 weeks, but their differing intensity forecasts could significantly influence market sentiment. Should the models converge on a colder scenario, it would likely ignite upward pressure on prices. Meanwhile, EU prices continue to decline, and if things don't go as expected, we could definitely see prices drop pretty sharply. It's one of those situations where a sudden shift could really turn things around. Despite surging demand, futures have struggled to clear the $3.70 resistance level. As I noted in my earlier forecast, if prices had managed to break and hold above the $3.75 threshold, the next move would likely have been toward the nearest resistance at $4. However, it now appears that this scenario is unlikely. Failure to break higher could push prices toward $3.40, with $3.20 offering secondary support. Prepare for volatile trading as the market navigates the tug-of-war between shifting weather patterns and surplus inventories. Please like, subscribe, and comment to support the channel. See you in the next one.